Hi, this is James Shrug with Westpac London's end of day report for Tuesday the 14th of August. There was a ream of economic data out today. The European session started off with national GDP growth figures for the second quarter. They're mostly positive, or at least not negative, with German GDP up 0.3%, Austria and Holland up 0.2%, and France flat. That's actually 4 quarters out of the last 5 that the French economy hasn't grown, but it hasn't contracted either in any of those quarters. The real disappointing one was Portugal, where GDP there slumped 1.2% in the quarter. And previously we knew that Italy was down 0.7% and Spain down 0.4%. So given that, the aggregate Euroland advanced estimate of GDP was a contraction of 0.1%. Now, we were looking for actually quite a bit steeper decline. It didn't come through. However, partial data through the quarter, and certainly business surveys that we've seen so far for the third quarter, do suggest that there's going to be a further deceleration in the Euroland economy as the current quarter proceeds. Our full year forecast for European GDP growth has been 1%, a contraction of 1% that is. We'll probably look to revise that back to something like a minus 0.7% decline on the basis of incorporating today's new data. Also in Europe, we had German ZEW analyst expectations fell for the 4th month running. And now, this survey often runs in sync with equity markets, and the German stock market, as with others, was up very strongly in August, but the ZEW survey kept falling. That could be a sign that German market participants don't like the idea that maybe Draghi's hinting at the European Central Bank actually monetising debt, which is one possible interpretation of the comments that he's been making recently in terms of bond market operations that might be unlimited. We don't yet know the details of the plan, but for whatever reason, the German analysts and investors don't seem happy with it, to the same extent at least the markets are. The UK CPI, it actually jumped slightly from 2.4 to 2.6%. Clothing and airfares were the issues there. Bad weather meant that there was heavy discounting in June of clothing. That was reversed somewhat in July. That came through as an increase in the annual rate, and also we think the Olympics was probably responsible for the airfare price hike, up 22% in the month, and the highest gain I think for 8 years. In the US, we had retail sales, 0.8% rise in the month of July. June revised to a 0.7% fall. What I think is more important is the core retail component, when you take out cars and gasoline, posted its first rise in 4 months. And it was a decent one too, up 0.9%. Now the question is that sustainable, or is that just a one-off data blip? And I've got to say that with US households looking more inclined to save and income growth constrained, it's more likely than not that that'll prove to be a one-off spurt in retailing. Producer prices up 0.3% in July, gasoline prices down, food prices up, also truck and car prices up sharply in July. That pushed the core rate to an above trend 0.4% rise. The National Federation of Independent Businesses reported its latest survey of small business optimism for July, weakest reading for the year so far, just a slight slippage, and it's pretty much replicating what we saw in the middle of 2011 with the spurt in confidence at the start of the year, falling away in the middle of the year. We had a renewed confidence come back in late 2011 and earlier this year. It's falling away again now. The issue now is, does it bounce back again later this year or not? A similar question to the one about retail sales. The first reading on consumer confidence for the US in the month of August was actually the weakest for the year so far. That's from IBD TIPP. That's probably it. They're the main data points today. There are other bits and pieces released. It's actually just coming up to 4 o'clock in London. I'm doing this a bit earlier than normal, so I'm not giving you closing prices, but as equity markets stand, we've got the FTSE in London up 0.4%, the French market up 0.3%, the Germans up 0.6%, the Spanish market's up 0.5%, and the Italian market up 0.6%. As I say, none of those markets are closed yet. The Dow at the moment is up 0.2%. The broader S&P measure up 0.2 as well. So we had, I think it was 7 days of gains on the S&P, fell yesterday, back in positive territory again today. In commodity markets, the gold price today down 0.6%. You can argue maybe that the retail sales numbers in the US make it a little bit less likely that the Fed will embark on another round of quantitative easing, which would tend to be a negative for the gold price, given that QE tends to boost commodity prices and other asset classes. Copper prices pretty much flat today, and we've got a 0.5% gain in the oil price, $93.22 a barrel. In Europe too, bond spreads came in a bit. German bond spreads out, German bond yields higher. Spain and Italy came in a bit, reflecting the view that healthier growth in Europe, even if not in Spain and Italy themselves, perhaps helps the sovereign debt crisis not resolve itself, but helps keep Europe alive at least. Aussie dollar, it fell on those retail sales figures. Again, I think it's related to the idea that maybe quantitative easing, another round, is just a little bit less likely, given strong retailing. Of course, if we're right and it turns out to be a blip in retailing rather than a new trend, then markets will change their mind again pretty soon. But the Aussie dollar on those figures fell from 1.054 to 1.048 against the US dollar, so more than 0.5% down on that news. We've got consumer sentiment out in Australia that we put out, Westpac puts out in conjunction with the Melbourne Institute, and also quarterly wages figures coming up for Australia. Okay, that's it for today. Back tomorrow.